I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Chris Vermeulen, his website, thegoldandoilguy.com. Welcome back to the show, Chris.
Hey, thanks for having me, Jim.
The markets, you say, are showing a remarkable resemblance to the crash of 87.
Yeah, if you were to take the chart of 1987 and overlay it on the chart going back to 2015 of this year, of last year, you overlay the last year and a half, more or less, from just before the crash happened in 1987 to what we're seeing right now. The charts have moved in almost an identical formation. Same kind of crashes and sell-offs, and the market is hanging on a cliff in a very bearish formation right now, and that's what it did back in 1987. And from the charts, it looks like technically we should start to see the market crash, this month. October is typically a bad month. We got a few sessions left in the month, but we're so close to mimicking a massive collapse in the equities market in 1987. It's kind of scary. And when you look at the recent price action and the market sentiment, it kind of, is pointing in that direction. If you look at the VIX is showing very little, almost no fear that stocks are going to crash. And money's been moving out of the safe haven plays like gold and silver and bonds and utilities because people aren't going into any of these defensive protective plays. They're thinking the stock market is just going to continue to rally, but the technicals and the chart patterns and this resemblance of the 1987 crash, man, it looks like we are, a couple weeks away at most from a potential massive crash. And all the last sell-offs we've had in the last year and a half, 2 years, the sell-offs have all happened. They're not really sell-offs; they're crashes. They're a 1 or 5 day event that the bars just go straight down. You have no time to get on board. By the time you try and get on these moves, huge percentage of moves are already done, and then you have a knee-jerk reaction back up. So I have a feeling we're going to repeat history, and things are going to break. And it might be somewhat contained with the whole election that's kind of creeping up, or it might actually happen because of the election. So you don't know what's going to happen, but the charts and the technicals resemble a big sell-off in the market, along with cycle analysis confirming this time frame.
What should people do if this is going to be true?
Well, the stock market typically falls 3 to 7 times faster than it rises, and I'm a huge fan of when things look very bearish to move out of equities and to take on some type of small position that is an inverse play. So I like inverse ETFs. You can trade them with you can benefit from falling prices using options or these leveraged inverse ETFs. You can put a small amount of money at work, and when the market tanks, these things skyrocket in value, and you can have substantial rewards with very little risk because of the leverage involved. And it's almost like an insurance policy. When you don't know what the markets are doing, they're unstable. Moving mostly to cash is the safest play. And then you can put on some type of buy some insurance on your account that'll profit if the stock market collapses. And, you can always get back into the market at any time. So, so many people worry that they're going to miss out on the next move or they need to be in the market all the time. But the key really, when we're in a time like this, when we've got some, the election, we've got these major market patterns and the short-term patterns all pointing to lower prices, the best play is to go to cash and do some speculative insurance plays. So that if the market crashes, this little position will jack up in value. and you can actually, profit from it and not get into a panic when some of this craziness happens in the market.
Well, it sounds like Warren Buffett has already taken your advice. He has $75 billion in cash waiting for the next big opportunity.
Yeah, well, it makes sense. Everything seems pretty frothy. Valuations are extremely high. It's the right thing to do. When something's in a bubble and it's been inflated and is way overvalued, the most, overvalued market there is, the smart thing to do is to slowly trim back, move to cash. Eventually there'll be some dump, some sell-off where things will slowly get back into more of a norm, and that's when you can start scaling back in and adding. But at these levels and kind of what has been taking place, cash is king for sure.
Well, all of Canada has about $73 billion in cash waiting for the next opportunity. People have taken the advice. Perhaps it's not a good idea to be in the equity markets right now. Will more people start taking that advice, and will that cause the eventual crash?
I think the initial crash is going to be more kind of short-term traders and automated kind of trading systems that thrive off this volatility, where they can trade in milliseconds and flood massive moves to flush out stops and run stops, and we see markets just collapse. I think the big move, the big sell-off, really still won't come probably to the very end of the bear market, and I don't see that. We have yet to enter it with large cap stocks. We're still actually very frothy trading up near these highs. But once we get into a bear market and confirm, which I think we're still months and months away from even that happening, until we've got that major technical breakdown and people are finally seeing quarter after quarter that their portfolios are declining, that's when the fear starts to creep in, and that's when they start to sell off, and they create that last, almost the biggest percentage slide overall of the bear market is at the last little bit when everybody starts to panic and the herd runs for the door, hitting the sell button. And that's usually when you start to see bonds actually really jump in value because people start to jump into those long-term bonds. So I think we're a long way from the herd creating the crash. I think the market, there isn't nearly the market depth, the liquidity that there used to be. It's extremely thin. So I think because of that, we're getting these very sharp crashes. It's a lot easier. You don't need the herd to create them. You just need some systems, and a couple $1 billion flowing in and out repeatedly can create these crashes intraday.
Now, of course, there's different kinds of crashes. Refresh us about what happened in 87. Was it a step down, as I say, a little bit down at a time, or was it one major correction?
Right, yeah. So, most people, when they think of a bear market or a correction, you kind of feel as though it's going to stair step its way lower and take some time. 87 was, we've seen a bunch of these, we call them crashes. It's like a little flash crash. It only lasts a few days, and massive percentage amount of the market has collapsed and dropped. So it's something that happens where you can blink or miss one day. You go away from the computer for one day and come back, and the market could be down, 5, 6, 7% in a day. These big crashes can take place, and that's kind of what the whole market has been showing ever since kind of early 2014. We've seen these very sharp, violent corrections, and investors are still very bullish, which is shown in the VIX and everything else that they're doing, not getting into safe haven plays. They jump right back in, and you get these knee-jerk reactions right back to the upside. But we're having more and more of these crashes. They're lasting longer and lingering down near the lows before they recover. And I think this last kind of pop that we've had in the stock market since July is kind of one of the last pops that we're going to have. And I think this one could start the waterfall sell-off, where we're going to start to pick up speed. And, right now the SP 500 is trading at 2140. The last kind of crashes that we had are down all the way down at almost 1800 marks. So, we've got 340 points in the SP 500 just to get down to the last crash, like a major support zone. And we have to break that support zone before we're really confirmed into a bear market. So this huge crash that could bring us down to these levels is just the tip of the iceberg, the tip of the bull market getting sliced off. And it has to break down from there and then crash substantially. So there's a lot of downside potential. And somebody who's playing an inverse ETF who moves to cash and is going to try and profit from these falling prices, once this momentum starts, there's a ridiculous amount of money that can be made by playing these inverse ETFs, because if the S&P 500 falls 20%, you could play a 3 times ETF and your account can jump 60%. And we're seeing these drops happen in sometimes a week and a half. With these last crashes we saw last October, we saw the one in July, and again in January. These crashes happen in like a week, so there's some massive potential. The key is managing your risk, and if the market does continue to grind higher, you don't want to be holding those plays, and it's understanding, when to get out and when to re-enter into these type of plays.
We'll have more with Chris Vermeulen right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Chris Vermeulen. Chris, when China's Shanghai market had a decline of, I think, 7%, the government stepped in and stopped trading, and then analysts told us that made the problem even worse because it caused panic because of the government intervention. Are there automatic stop losses here where the market would just freeze?
There are. The indexes, the futures markets, if they move a certain amount, they will have they're called circuit breakers. So the market will halt and freeze for a while. Depending on the severity, it could halt for a day or more. I don't think, I think it is a good idea to have these circuit breakers, because, or else you'd have too many people panicking, and when somebody gets backed into a corner and they're completely scared, crazy things happen. They will dump and sell everything to get out of it in pure panic. It's the emotions are so high that they could kill the market in a much bigger way. So these circuit breakers allow at least a little bit of level headedness to come back into the market to kind of digest and be like, okay, that was a bad day. Don't need to panic out. Maybe I'll sell some of it and see how it goes. I think you need to have these circuit breakers in place, or else it'll just create a waterfall where the market just, who knows how much value it could lose once that downward spiral happens. And of course, the more it falls, the more margin calls you're going to have, so it starts to compound. And when somebody has a margin call, whether they're at their computer or not, the broker is going to execute and sell their positions. So as the market falls further and further, it creates more margin calls, creating more selling, and it's just a downward spiral that happens extremely quickly. So these circuit breakers definitely help, I think, kind of protect the market, because we don't really want to see the stock market completely crash. That's not healthy for anyone, really.
Well, Germany has banned short trading. Would that make a difference in North America?
Oh, I think it'd be a huge difference. I remember when they took the uptick rule away for trading, and I think that was back in 2007, 2008. I can't remember. And that to me, now anybody can just short anytime you want. And if you're a big institution and you can see something trading at a level that if you could short a couple thousand shares, you could break a support zone and force even more selling. And it's just incredible what the manipulation that can be done. And I don't think you should be allowed to short unless there is an uptick rule. It was there to protect the market, but of course, the insiders obviously know that, and they want to remove it because they can benefit with their systems and their insider information of trading strategies and data. That I think I think it got removed because there's so much potential in shorting and crashing stocks that they just got muscled into saying, oh, okay, let's remove it. They were sold on the idea that it's not bad, but I think it's a terrible idea. I think uptick rules should come back into place. And, I think it would help. It's not going to definitely resolve things. When people want to sell, they will sell continuously anytime there's an uptick, but it just stops that waterfall of it selling down and then more people piling on and jumping on and drowning a stock. you've got to wait for some buyer to step in and say, oh, I'll buy something before you can step back on it, It makes a big difference.
How does this change or affect people's positions on things like gold and crude oil?
Well, back in 2008, we saw the stock market crash in a big way, and we saw gold and miners, everything kind of crashed. And I think that had to do with margin calls and obviously the no uptick rule. Thinner asset classes like gold and silver that are traded much more thinly, not having an uptick rule, all that stuff can create some problems with the stocks, for sure. But, we've saw a little bit of a decouple from the sell-off that we had in January this year, where we saw money pile into bonds, we saw money pile into gold, which was a really good sign, showing that there is some big money watching and actually getting ready to, or loading up on those asset classes. When we saw back in 2007 and 8, when the market topped and sold off, we saw gold get hit really hard. I think a lot of it had to do with margin calls. People are loading up on gold and gold stocks and silver. And once they, there's so much leverage involved with futures that as soon as they start to move against you, it's very easy to get a margin call and create a wave of selling. And something that's very thinly traded, once the selling starts, it completely decimates the asset or the commodity price. It just completely goes into free fall. So, the lack of liquidity in the market is a major problem when it comes to gold and silver markets. They're highly manipulated. It's kind of been proven, but nothing really seems to get done about it. But the fact that money has been moving in when the market has been crashing is a good sign that there's some big institutional money identifying the safe plays and kind of moving into them.
How long can oil stay around $50 a barrel?
Yeah, oil has been holding up extremely well. It's formed a very large basing pattern, potentially a large cup and handle pattern, and it just continues to hold between this more or less 49 and almost 52 level. And I think it's got the potential to hold up really well here. We might actually see it rocket higher. I actually did a video today talking about crude oil with an upside target of 58.50 on crude oil. If it can break above the recent highs around 51.85, I think it could be up to 58.54. That'll bring it up to a resistance zone from early in the year, back in April and May. And that would give it a full Fibonacci measured move, 100% move. And that would just be potentially the start of something much larger. Again, it's a cup and handle formation. Typically, you can take the depth of the top of the cup to the bottom of the handle. For crude oil, it put in a nice double bottom earlier this year. And you can flip that to the upside, usually 2 or 3 times. So we'd be looking at, maybe $95 per barrel crude oil if this pattern breaks out and it really starts to pick up speed to the upside.
What about talk that the U.S. is going to reinstitute sanctions against Iran? What kind of an effect would that have on oil?
Yeah, I think that would be. I think it would obviously be bullish for oil. I think it's going to put more demand on the U.S. Overall, it's bullish for crude oil going forward, and I think that might be one of the reasons why it's holding up really well here. It's very close to, it wants to move higher. It's just struggling at this point, but it's got nice heavy volume, big accumulation. It's trading in a very tight range. I think it's just a matter of time before we see it actually pop and have a significant move up to that 58, and then we'll be back into a full-fledged bull market for crude oil. And depending what happens financially overseas, if there's some big things that unfold, crude oil tends to rise in value, and so will gold. And I think commodities, they've been warming up. A lot of commodities have put in major basing patterns. Some of them are starting to break out, like natural gas. So commodities are becoming kind of the favored play here.
Farmer's Almanac is predicting a colder winter. Is that good for natural gas?
Yeah, I think we had a cold wave here, and we saw natural gas, break out of this basing pattern at the $3 mark a couple of weeks ago. Had a strong pop, rallied all the way up to $3.35, excuse me, and it's crashed right back down, but that was a very strong move that it had to the upside. It's fizzled back down, but it's just, as of today, getting into a nice oversold condition. It's trading at a support zone. And what I'm looking for right now on the daily chart of natural gas is simply a reversal candle to the upside. If we have a long lower wick or a very strong close at the top of the day, at the top of the candle, excuse me, then I'll be looking to jump in natural gas to catch a momentum play back up to the 3 or potentially about the 308 level.
Chris, thank you so much for chatting with us.
Hey, always a pleasure, Jim. Thanks for having me on the show.
My guest has been Chris Vermeulen, his website, thegoldanoilguy.com. You're listening to HowStreet.com Radio, our YouTube channel, Talk Digital Network. You can find us on Twitter at TalkDigitalNet. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.